All right, so we started off today in the week here pretty bearish. We were kind of looking for that possibility of a pretty steep opening gap to the downside. What was a little bit unexpected was we didn't follow up that opening gap with more selling throughout the day. In fact, we kind of hit a low point and held that low point for most of the day and then rallied at the very end. Very strong rally, especially in the tech space. So what does that tell us? Does that tell us that we've had the extent of this pullback now? Is that the low point? Is that just kind of, again, a warning shot for potentially more weakness tomorrow if we were to have a steep selling day throughout the day tomorrow instead of just at the open, as we saw most of today's selling was mostly before the open. So I'm going to break that down and what these technical indicators expect and what type of move we might expect even as early as tomorrow, and what kind of follow through we might get to today's move, and what that can mean in terms of the extent of any kind of intermediate declines, and whether or not we can expect a deeper one, and where we can expect most of the selling if we are to be in more of a protracted intermediate decline. Where will most of the selling be? And we're going to talk about how to trade that if that ends up being the case with today's trade idea. So let's go ahead and get started. Today is Monday, September the 21st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator here and see how things develop today. Again, still have the dark pink shading and the red line, so a second day of that. But you notice here that while we did go below the 23% retracement level, we end up closing up above it. Very important. Very important move. A little bit of a long lower shadow we haven't gotten for a while. Last time we got that was over here back on September the 4th. It kept the short-term sentiment again. We were flirting with an oversold cluster all day long at the lows of the day, but because of the rally off the low, it brought the short-term lines up again. Very similar to Friday, even if it wasn't that much of a rally. But again, enough of a rally to get us back up above the 23% retracement level for the S&P. Of course, the Dow now has dark pink shading and a red line. It is not below its 23% retracement. Is not below the 78% retracement of the decline there. So that's something to keep an eye on. The Nasdaq, of course, was more bearish, but then rallied off the close. You can see the short-term sentiment looks more bullish than any of the others. Very strong rally off of the lows of the day today. And then finally, the Russell 2000, because it has such a big influence, or financials and industrials, especially financials, has such a big influence on the small cap index. It really dropped pretty sharply and finally has its own dark pink shading and red lines. So dark pink shading, red lines across the board, even if right now the Nasdaq is the only one that's trading below its 23% retracement. Everything else is relatively close. The Dow and the Russell are the furthest away, and the S&P is kind of sitting right on that. So getting the pullbacks, breaking this line, especially if it happens tomorrow. And I mentioned Friday, we talked in my technical analysis class of this scenario where we really drop pretty sharply and get these indicators showing the signs of the decline, right? Where your RSI breaks and below 40, and with the low point, you kind of really, we were well below 40 earlier today, and then flirting with negative 200, and we got neither. So if we were to follow up today's move with a big sharp drop tomorrow, say down to 3,200 on the S&P, then that would be probably what you'd need to get those levels. You can see, remember on Friday, the DMI did hit above 30 and below 10, and that continued to be the case here. And one more big sharp drop tomorrow would really spike it up, the negative up above 40, the positive closer down to 10. Because remember, the biggest moves are right at the very beginning of intermediate pullbacks. Even if you were to go back to 2018 when we had this intermediate pullback here that lasted a few months, the biggest moves occurred early, right off the bat. Got above 40, got closer to 10. Then we kind of were grinding down lower and had some up and down moves after that. So if this is the intermediate pullback, I think if this is it, if this is the drop, then that means probably tomorrow we're going to really follow through on today's weakness with some even more selling and a sharper move to the downside, where you have the daily price moves. You can see you've got, again, a pretty decent gap here. Not as big as, about as big, excuse me, as these others, but again, not really a big close. So kind of looking for that big close, 2-3% to the downside. Kind of what I mentioned in technical analysis on Friday, there was a twofold scenario. One was that we would gap down by 2% today, and that pretty much happened. They were close to it. We were close to 2% mark. Got there really quickly after the open. And then the other aspect of it was that we would finish today down 4 or 5%. That would have been like, okay, here that's it. And again, most of the damage being done early, because as you can see from the Bollinger Bands, we did drop, we stayed this time below the 25th percentile on both of these. But you also notice again how hard it's going to be for us to really have significant declines in the S&P, even if we break the point of control here, because you have a really big layer of volume, which was the point of control, right above the 38% retracement and right below the 78 of the decline. So you can kind of see how much further really we have to go here. If you look at IWM, you can see it's sitting on its point of control. It took a long time for it to get above it, and it didn't get very far above it, but there's a lot of volume here. If we break this 23%, then there's a pretty decent free fall. But considering that we're not above the pre-COVID highs, like say the NASDAQ is, then most likely we're not. So that kind of limits how big any downside moves are. Whereas the NASDAQ, you can see it can get all the way down to the 38% retracement without getting into the value area, much less to its point of control, much less to the pre-COVID, below the pre-COVID high, which is in the middle of the retracement zone. So that kind of gives you an idea that NASDAQ actually has a little bit more room to fall than some of these other major indexes. We didn't look at the Dow, but you can see the Dow also sitting right on its point of control, the 1-year point of control. So lots of volume in these areas, lots of support in these areas, which makes a sharp move to the downside unlikely tomorrow. Maybe in the NASDAQ, but unlikely everywhere else. Kind of what we saw last week, where the NASDAQ fell, but IWM was actually up, as you saw on Friday. So more than likely, we'll get some weakness here in the Qs, but not a lot of weakness, especially by the end of the days in some of these other areas. And this might be it. This might be all the... Now, it doesn't mean that we're going to go up now and start a bullish leg, because I do think this intermediate pullback will last a month or two. I just don't think it will go down for the full month or two. I know that, based off this COVID decline and everything we've seen previously, it's like the markets either go up every day or they go down every day. And that's just not the case, right? We're probably going to go up and down and just grind in this area for a while, right? For a while, whether it's, you can see IWM, probably not getting too much lower than its 23% retracement, but probably not getting too much higher than this 100% line either. We're probably just kind of grinding in this area, and that's what I expect all the broader markets to do as well. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. You liked our video today, and you want us to do another video again tomorrow. It's a quick way to give us feedback. If you like our videos and you want to let us know, you can do so with one click right now while you're watching. If you don't like our videos, of course, you don't have to click on anything or even watch. Also, while you're down there, comment. What did you get out of our videos today? What questions or comments do you have? What stood out to you? I'd love to see what you're getting out of the video. Join our website at marketscholars.com. There's a link popping out right there at the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, we invite you to check out these things over here on the right, including the Market Outlook live video. So every day I do the Market Outlook. I do a live video where I review all the old trades that we've talked about in these videos, as well as we put on today's trade before the market closes. I do that at 3:30 Eastern time on YouTube. You can access to it right here by clicking on this link, this image. Here's all of our classes. including Brandon's very, very popular dividend growth investing. It's one of our most popular classes we have here at Market Scholars. Again, all of our subscribers, our plus and our premium subscribers, our monthly subscribers or our plus subscribers, all of them get access to both the Market Outlook Live and all the classes. Our Q&A sessions are reserved for our premium subscribers, as well as all of our tools and resources and community access. But plus subscribers get access to all the classes as well as all the old recordings. So you can go back and watch my Friday technical analysis class there. We also invite you to come over here, hit this heart. It opens up a new window. Hit that like button right there. Also hit this thumbs up. Also opens up a new tab where you can go to your Facebook account, hit that like button there. Again, the more you do that, the more Twitter and Facebook will promote our content to all of our followers, not just 122 of them. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here on our blog. You can even share it with one click on Facebook or on Twitter or on LinkedIn, as well as email it to anybody right down here, right below the video. Very, very easy for you to engage with us here. All right, let's take a look at go back to the charts here. Let's take a look at the long term. Again, this is a bearish candle, right? So, no high, it's a lower low, it's a lower close, it's a no upper shadow. So as of right now, that's a pretty bearish candle there and could lead to more. So we'll see. Again, you can see the 200-day moving average or the 40-week moving average is right at the 78% retracement. So you can kind of get an idea of where we might fall down to and why it's unlikely we will fall down there on to the 38%. NASDAQ, however, different story. You can see the 200-day moving average is well below the 38%. So very, very easy for the NASDAQ to come down further to its 38% line. And then, of course, you look at the Russell 2000, and it already is trading pretty much at the 200-day moving average. We got down to it here today. So its 23% is also a little bit below us. So that's probably about the range. So again, there's not a whole lot of downside left. As much as we really haven't gone down that much anyway, especially compared to the rally, but there's not a lot left on these major indexes. The most downside is right now because of the lack of margin of safety. It happens to be in the NASDAQ 100, but even then, again, we're not talking like change of trends in the least bit. We're just talking about just retracing some of the tremendous move we had to this point before we start a new one, which is very, very typical. And as you go back in history, that's just what happens. Every time you have a move higher, you get red arrows and then you get green arrows again, and there you go. So it looks a little bit worse now because it's not on a log scale chart, which is more appropriate to you. There we go. So you can kind of see every time you go up, you have retracements. That's the nature of the beast, and that's what we appear to be getting right now, even with the PPO here still very, very high relative to any other peak that we've had in the last 20 years, especially since the tech bubble burst. Obviously, before the tech bubble burst, we had some really, really high PPOs, but since then, this is about as high as we've gotten. Let's take a look at the 3 green arrow chart, and you'll notice here we got 3 red arrows still, and we're rolling over. The MACD histogram's rolling over. We got decent volume at 100 million shares trading. A little bit below average on the range. That does not include, though, the gap. So we actually gapped down from 330.65, the high today at 327, so over 3 points. So you're probably looking at about 8.5 point range with that 99 million shares trading hands. So that kind of gives you an idea of how things are moving here. And you look at the 3 green arrow, or you look 2 line versions, excuse me. We are well below the 8-day moving average. The 8, we're not bouncing back up to 17 in another day or two. And you can see the histogram rolling over. The stochastics crossing back down below its moving average, while easily below 25, which gives you that red arrow on the 3 green arrow chart. So, again, we could have been a lot more bearish at the lows of the day, and we might fill in the lows of the day tomorrow. We might gap up a little higher, finish filling in this gap, and then really come down tomorrow. So we can not go down very much further, but still have a big down day tomorrow. at least an intraday down move. If we were to say gap up and move up early and then really fall down by the close and close near the lows where that big strong support is. Because again, while there's a lot of room to fall in the NASDAQ, there's not very much. There's a lot of really strong support in these areas on the Russell, on the S&P, even on the Dow Jones Industrial Average. So there might be a little upward move, but there also is, could be a very significant downward move that can really produce those bearish signals and really solidify this intermediate pullback. And with most of the damage now being done, now it's just a matter of ups and downs, right? Ups and downs while we kind of mess around here, potentially until we get through the election. It's going to be really hard to get a good, strong intermediate run started with all the volatility expected with the election. When you take a look at today's intraday chart, this is what I'm talking about. So again, we might finish filling this in and kind of hit a resistance here before, and that could be really, really early. In fact, it could happen overnight. Looks like we are actually up a couple bucks or more than $1 overnight, up to 328. So we're up into this area. We could finish that overnight, early tomorrow morning before having another down day. And again, how much more downside? Well, you're looking at about 322 where your point of control is, and maybe down to 315 in that area where the 78% line is. That's probably about all the downside possibilities there are right now in the S&P. So it kind of gives you an idea there of how you can both be bullish and bearish as early as tomorrow and Wednesday to help really bring the Qs down. The Qs did finish filling in the gap. There's still a little bit more of a gap that it can fill in up here. So we'll see if that ends up being the case before things finally roll over and as it meets its own resistance up here at 274. You can see it's also up a little bit more than $1 in the after hours right now. So I mentioned the volume about 100 million and the trading range over 8 points. So obviously bringing both these numbers high. You can see the ATR is close to being above the 2% mark there at 6 points. So obviously, this is kind of the signs here that we are getting, this decline. The nice thing is, and here's another sign, the volatility is just not jumping up very high. If this is the intermediate pullback and this is all we get in terms of volatility, how nice is that going to be, right? Because eventually we'll break down below 20 and 15 as we start a bullish intermediate run, but more likely there's still a move on volatility up towards 100%, if not a little through that, before all is said and done. So, if you think this was a volatility spike, that only got us into the neutral zone. Remember, we're still waiting for one to get up through the neutral zone up to 100%, and then that's it, right? And then, so again, could that happen tomorrow? Could we hit the 85% mark and then take off? Could there be some kind of catalyst by the end of the week that causes that? Definitely. So kind of keep an eye on that, and that would really signify that we have hit this run, that this intermediate pullback. Of course, you'll get the spike, most likely get the spike above 40, closer down to 10 on here, so you get the really significant bearish move there. The Bollinger Bands will probably break below the lower band, or something like this again, which typically happens at the very beginning of the intermediate pullbacks. Then we just kind of mess around. I can show you again 2018 and how that looked like when we first broke it. You can see we broke early, got below the lower band on the big move to the downside, Same thing here in the fall of 2018. Same thing here in February of 2000. So we broke that lower band. So expect a little bit of a breaking of that lower band to occur here. Again, it would have to be pretty quick too, because that lower band's on its way down. So could it be tomorrow? For sure. Even if we rally in the pre-market first and peak early in the day, right? Because I've told you that before a lot of times. Either the high of the day is early or the low of the day is early. Today, the low of the day was early. Friday, the high of the day was early. Thursday, the low of the day was early. Friday, it was kind of in the middle. We got the high and the low of the day late, which kind of is not necessarily the best thing. So, could we get the high of the day early tomorrow, really right off the bat, and then drop pretty sharply? That's definitely something to be aware of and keep an eye out for. again, depending upon what kind of catalyst might be out there that can produce sentiment to do that, right, after filling in the gap early in the morning, overnight, and the European session, especially with the euro. I mentioned the euro US dollar, didn't confirm the move that we saw in the futures. Well, today it did, right? So if the euro were to also break down, after recovering some of these losses in the European session, then you can kind of see from an intermarket relationship how that can work as well. All right, so to summarize that technical outlook before I look at some other charts here, this kind of gives you an idea that like this intermediate, like we might be in the beginnings of the intermediate, kind of a ho-hum intermediate pullback right now, where the biggest move still is yet to occur. But even that biggest move might not be a sharp decline. It might not come until after we bounce first, as early as overnight tonight, before we get the bigger move that really produces the sharp moves on the indicators that confirm that this is indeed the intermediate pullback. And even that being said, intermediate pullbacks, this might be the extent, most of it, that we're already seeing, and that we will see even after any kind of negative move that we might get tomorrow. Like, this, I know we're so accustomed to intermediate pullbacks, like, again, early 2018 and fall of 2018, and then this COVID low point. But the reality is, a lot of time, some intermediate pullbacks are just ho-hum, and it appears that this one appears to be just ho-hum. Not so much for the Nasdaq, but it's got more room to fall. It's got the worst margin of safety. But for some of these others that didn't take off, especially the Russell, you can expect the Russell just to be kind of flat as a pancake here for a while. Doesn't have much to lose, didn't have much to gain either. So it's going to be kind of flat, kind of following the trend it's had since 2018, flat as a pancake for potentially the next month or two, while the other major indexes work through their intermediate pullback and eventually re-engage on a new bullish intermediate run. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section down below, especially if you disagree. Comment as to why. What are you seeing that suggests why you're either a lot more bullish than I am, or that you're a lot more bearish than I am? All right, so now let's take a look at what's driving this price action. And I've been talking a lot about tailwinds. There's a lot of tailwinds for the market. So the dollar had a pretty decent decline today, but still easily above its 23, or the dollar, had a pretty decent rally. The euro had a decline, pretty decent move, but still above the 23%. So the long-term downward move on the dollar, which is kind of what we still would expect. You can see the the golden cross on this pair. Strong positive momentum. Not diverging yet, at least. This is still kind of the first move. So there's still an opportunity for us to continue to trend long-term to the upside. And you can also see, too, from a long-term market forecast perspective, that's still very strongly bullish. So with short-term sentiment pretty oversold. So that's the S&P, sorry. Let's take again another reason why there might not be a whole lot of downside left to the S&P, even though we might kind of hammer around a little bit for a while. But same thing on the euro US dollar. You can see the short-term sentiment's down, bullish intermediate confirmation signal this week if it finishes like this week. So you get the idea, right? We can be bullish here for a while. It's got a tremendous tailwind. I also mentioned to you from an intermarket standpoint here that the 10-year yield is also a tailwind, right? Being at less than 70 basis points and coming down a little bit here, setting up for its own little bounce. But still being below well below 1%, being about half, less than half of what the dividend yield for the S&P 500 is. That is a tremendous tailwind. Here's another tailwind that doesn't really get brought up too much here lately, and that's the yield curve. That I've talked to you before that we've been in the stealth bear market since the beginning of 2018, but especially since the fall of 2018, at least in the U.S. with all the other asset classes. International stocks peaked. They had a real significant peak in the early 2018. Well, look at this chart here. That's a chart that kind of shows recession or bear market. So you can see it, similar here and similar here. And when it went flat, when it dropped sharply and went flat, that's just kind of what it, and you can see here March of 2009. That pretty much signals a bottom, a low. And and then we bounce off of these lows. You can see the black line, we bounce off of these lows and we come down to these, and we get to really low levels in the overnight rates, and the 10-year yield bounces. So I expect the 10-year yield to bounce again in this area. So eventually it won't be such a tailwind, but as of right, and the reason why is, again, that is like half of the S&P 500's yield, and the 30-year, which is this orange line, is actually below the 30-year yield. So you expect that to rally up and get it, or excuse me, above the dividend yield as well, because it's not normal for the S&P's dividend yield to be a lot more attractive than the 30-year bond, or the 10-year bond, excuse me, much less the 30-year bond. So a tremendous tailwind for equities, because that will, as equities rally, even though they're already at their highs, as equities rally, that will bring their dividend yield down. But the yields, you can see, there's opportunity. That's bullish when they rally. It's also a sign of inflation expectations rising. We look at commodities, in particular, kind of gold and crude oil. You can see crude oil has been, or the commodity basket as a whole has been pretty bullish. Still really unable to kind of break through and finish filling in this volume gap. It's actually built in this pretty decent volume in this area, right about 13.5. So it's got a decent gap to break through and get back up to 15.5. Remember, the point of control, once you're in the value area, the point of control acts as a center of gravity. So that's going to be a draw up on commodities. And as commodities move and lag, as you would expect they would, again, another sign of inflation. So falling dollar, rising commodities, and rising yields, all signs of rising inflation expectations, which is bullish for equities. So, again, more tailwinds, even if we do get some short-term weakness, even if that weakness is more limited to like these large cap tech names that have more room to be weak. Once it's all said and done, the Earth's not going to collapse. The market's not going to go crazy. We're not headed towards Armageddon. This is not the biggest election of our lifetimes, because everybody has said it's the biggest election of our lifetimes. I guess we're going to get through the election. The market's going to get through it, and then we'll come out of it on the other side, and with the same type of move we've had. I expect the same type of move we had going into it. A nice, good, bullish long-term trend that's driven by these tremendous tailwinds, and again, another one is this unwinding of the safety trade that hasn't unwound even though we've been rallying in equities. The safety trade itself is also still, from gold to long-term bonds, is still very, very overbought. You can see long-term bonds still have some breaking down themselves to do for us to unwind the safety trade and move a lot of cash that's even come out. I tweeted this out earlier today. A lot of cash, or a lot of outflows that have come out earlier in the year are starting to come back in. Another tremendous tailwind once we get through this period of intermediate weakness. Now let's take a look at the sector performance and see what it's doing, and you can see the declines that we're getting on a 3-month basis. You can see the strength that we've had in technology and communication services and discretionary materials and industrials also. That's been our strength, but really since we peaked here on September the 2nd, if I were to do this, change this to September the 2nd, up until now, you can see, what was the strength is now our weakness, and not surprising, right? And on the other end of the spectrum, you can see what's outperforming is pretty much everything else except for energy, even if there are small negative numbers from that September 2nd peak here. Let's actually go to the 3rd, and you can see, there we go, down 13, 12 from this close on September the 2nd, down 12, 13% there, and you can see energy and some of these others down 4 or 5%, still down, but outperforming the markets as a whole. Just looking at today alone here, let's go to 10 minutes. So you can see the reversal, the downside, and then the upside. You can, interestingly enough, it's these dollar sensitive areas that what we were supposed to be cycling ourselves into, right? Their great rotation. They started to the downside. They stayed down throughout most of the day, while technology started up strong and then rallied and actually finished on the positive side. even if the rest of the markets stayed down. So this is kind of a one, like, it was a risk-off day, and it was a risk-off day in terms of these cyclical areas being weak. Our leadership continues to be in those QQQ names, and there's going to be times where they fall, and they're going to fall most likely here in the short term more than some of these other areas. But these other areas, eventually when we do bottom out and we start to bounce, you can see when we bounce off of lows, they're going to lead the bounces up, just like we saw here today. And that brings us to our trade idea of the day. And I want to take a look at one of those technology stocks that has quite the margin of safety to work with. And you can see it's NVIDIA. NVIDIA, it's got a little bit of a pullback going on. It's trading around its 23% retracement. There's a little bit of a volume node around here. But once we break this, you can see there's not very much volume, all the way down to the value area, all the way down to and through its Fibonacci retracement zone, pretty much through most of it down to the lower end here. So there's, if things do get weak in the tech space, and again, not necessarily because we're falling off a cliff or we're going into a bear market or recession, not every downward move, but just because it rallied up so much. And the tightrope, I've always used the analogy of the tightrope and where the ground is. See, the ground's right down here where the value area is, and the tightrope's way up here. And there's not a whole lot of volume in between. There's support. So if you fall off the platform, off the tightrope, then you can see where the ground is. So we can take advantage of those types of moves, even with just like a hedging type move, right? I mean, it's a good bullish stock, and it's going to be a good buying opportunity, and maybe right now might be a good buying opportunity. But if it's not, and we do get, again, more weakness in the tech space than we do in, say, small cap stocks, then this is going to be one place that we can have a pretty decent hedge. We've done one recently on Apple. We had a long call vertical back over here, actually. It was on one of the, it might have been on September the 2nd that we did the long put vertical on Apple. It was just a hedge, especially with an iron condor that we had going on. Well, that hedge is working out fine. And now here's another opportunity for us to have another, this small, low risk, but high reward hedge in case this does pull back more than the rest of the market does. So what kind of trade can we do? Again, low risk, high reward opportunity. And we say, okay, well, let's take a look at NVIDIA here, and let's sell the 420, buy the 425, the put vertical spread. You can see the rally we had after we did this in my Market Outlook live session. We're only down $100, and we got $600 of risk. And ideally, if this continues to rally and we do break up to the upside, then I can keep my risk at $300, and I'd be just fine. Because if this does break down and we do, by October expiration, have a lot more weakness on the NASDAQ than anywhere else, and we drop down to 420, which on NVIDIA is, get back to that chart, 420 is this right here in this area. You can see by October expiration, 429 is where one standard deviation. So just basically a little bit below that to this volume node. If that's where we fall down to, then for that roughly $300 of risk, and then I have the potential of about $3,400 of reward. So a 10-to-1 reward to risk ratio on a hedge, low probability, but still, just in case, right? Just in case there is any broader weakness, and this is where we'd expect the broader weakness to, most of the weakness to be, then we have something here. We have something here while we can use this drop and sell, put vertical spreads like we talked about in Friday's Market Outlook and other things to take advantage of this move. And have this one little, and maybe one or two others too, just small little hedges, small risk hedges that can really pay off in the worst case scenario, that can help offset losses you might be getting in some of your higher probability bullish spreads right now. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, get access to those forums. So check it out there, and let's keep this conversation going. Open up any new threads you have. Reply to anybody else's threads. As always, thank you for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on Twitter and Facebook too. and comment on our video down below. Follow me on Twitter at DavidSettle42 for more content between the videos, and join our Market Outlook Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.